The housing market is in turmoil, and this is not just another cool down. Home prices are falling in 61% of the United States, and that figure is rising every week. Buyers are pulling back hard. Home purchase cancellations are at their highest rates since the peak of the COVID collapse in 2020, as uncertainty and cost push families out of the market. And the market itself, well, it's frozen, stuck in a perpetual crisis, as more than 75% of Americans couldn't afford to buy a home of the same price again today, keeping them stuck with golden handcuffs. That means those forced sales, relocations, inheritances, they're leading to massive discounts and seller desperation. And as all of this unravels, there is no respite. The Fed just announced that they're not cutting rates again for the fourth consecutive month. And with inflation uncertain, the economy uncertain, you can best bet that trend is going to continue, keeping interest rates higher for longer. This video is going to expose what's really happening behind the headlines and why this crash is literally years from being over. Now, if that worries you, I don't blame you, because it worries me too, which is why I've done everything I could over the last 4 years to detach myself from the traditional economy. My business now has clients all over the world, so I'm as heavily hedged against a housing crash as I could be. And if you want to build that same security for yourself or for your family, my business Grow Coach helps experts and enthusiasts turn their knowledge, experience, and expertise into six-figure online coaching and consulting businesses. And I made a very special free guide for you explaining how the industry works and how you can build your own online education business to 6 figures a year, and you can download that free guide in the link down below in the description. Now, the housing market in the US and in most other first world countries at this point has switched from a seller's market to a buyer's market. A couple of years ago, if you wanted to buy a house that had 4 walls and a roof, you'd find yourself bidding against 5 other people and paying 15% over the asking price, and then the seller would try and gouge you out of an extra 5% just because they could. There were literally trillions of dollars flung into the economy and forced into people's pockets, with interest rates as low as literally 1% on an appreciating asset that you lived in, so everyone and their mum were buying homes. There literally were not enough sellers to keep up, so those sellers controlled the market and they got the deal of a lifetime over and over again. That is, though, no longer the case, and now sellers are getting shafted as they can't find people to buy their homes under what they paid, let alone above. Right now, there are 34% more buyers in the market in the US than sellers, which amounts to a surplus of 400,000, the highest ever recorded according to Redfin. The only time it's ever been even as close to a buyer's market as it is today is during the deepest trough of the global financial crisis, where real estate fell by 40%. 31 of the top 50 metro areas in the US are now clear buyer's markets, with cities like Miami literally having 3 times as many sellers as buyers. Now, as everyone knows, when supply outweighs demand, the only thing that's ever going to happen is prices will fall until sellers drop out of the market because they no longer want to sell, or buyers move into the market because they now see value. So prices are falling, and it's going to continue. House prices are expected to fall by 1% over the course of the rest of 2025 across the United States, according to Redfin. So when taking into account inflation, we're looking at a 4% decline. Now, that may not sound huge, but what everyone forgets is that the housing market is the slowest market to react in the world. And in 2006, when we saw literally the worst housing crash in history, prices only fell by about 6% that year. The issue is that they continue to fall at that rate, and worse, for the following 5 years as well. The only thing really stopping this slow crash from becoming a very, very fast one, well, that's frozen inventory. Right now, the US is seeing a historical low in housing inventory, meaning there just aren't that many sellers right now. Over the entirety of 2024, only 2.5% of homes actually changed hands, which is the lowest proportion of homes in recorded history. This is all because of the mortgage lock-in effect, which has frozen tens of millions into homes that they really should have never been able to afford in the first place. People were literally getting mortgages with rates as low as 1%, meaning the monthly repayments on a $500,000 loan were only around $1,600. Now, with average mortgage rates at just under 7%, and that same $500,000 loan costs $3,300 per month, literally double what it did before. That doesn't mean that half as many people can afford that house now. It means 1/4 as many people can afford it. So suddenly it starts to make sense why there are just so few buyers. But it also makes sense why there is such a lack of sellers as well. If you have a low interest rate mortgage, you can't afford to sell unless you plan on just never buying another another home again. You could downsize and buy a house literally half the price, and you'll still end up paying more on your monthly mortgage. We're seeing a completely gridlocked market with fewer buyers and sellers, leading to a massive trough in the real estate market countrywide. And worse yet, this problem isn't easily solved. Home builders could help flood the market with supply, except in reality, the amount of homes that they'd need to build to counteract that historic low of typical sellers is into the tens of millions, and these home builders simply can't keep up. And with interest rates stuck high, the cost of buying isn't going to go down anytime sooner. Now, most people think then that at least the number of sellers and buyers is low together, so they can sort of balance each other out. And for those who are stuck in a house that they couldn't really ever afford, as long as they stay put, then they are fine as well. And that would be true, both of those things in a perfect world, but in reality, people usually move home out of necessity, not really out of choice. New jobs, growing families, a rising cost of living, work from home rollbacks, there are myriad different things that cause people to have to sell their homes, and every single time that happens, it takes a massive chunk out of the economy. It forces housing prices lower, and it forces household expenditures higher, and there's simply no way around it. The only savings grace is that because this is such a nightmare, those who are forced to sell are incredibly reluctant, meaning they are only going when they've lost all breathing room and have literally no other choice left, which means the collapse caused by this crisis is slow moving and not sudden. And the total result of all this, well, as of early 2024, 61% of the states in the United States have already seen prices fall, and that number is growing. Data is slow to be released, but all evidence points to that number being much closer to 85% by the time we actually get data from today, mid-2025. Previous states that were booming, that were seeing housing prices continue to rise even as COVID was left behind, like Florida and Colorado and California, they're all seeing prices fall as we speak. Florida alone is seeing prices fall by 0.5% per month, more than 6% annualized over the course of a year, and that's without taking into account inflation. The Sunbelt in particular is getting pounded as a direct result of it also being one of the areas that benefited the most from the COVID price explosion. Texas is seeing prices fall, with Austin seeing prices down 5% over the last year, and Dallas seeing them fall by 3%. Orlando's down by 3%, and Atlanta's down by 2.5% too. This is a very perilous situation to be in. The market is falling, affordability is at a breaking point, leverage has shifted from sellers to buyers, and transactions are at all-time lows. This standoff will persist for a time, but it's far more likely to be broken by a rush of supply causing prices to fall fast and sharp, as opposed to a rush of demand causing prices to stabilize. Now, this alone is enough to send anyone with half a brain cell worrying, but it does unfortunately get worse, and that's exactly why I've spent so much of my time over the last 4 years detaching myself from anything that can be impacted by the housing market as much as possible. Now, I realize that there's essentially been a revolution since the pandemic in the online education industry, so much so that it's now worth more than $200 billion a year. This revolution is all based on experts and enthusiasts selling their knowledge, experience, and expertise to those who want to learn online, essentially building their own fully online consulting or coaching businesses. And that's exactly what my business Grow Coach helps people to do. Coaches in this industry now aren't limited by geography. We can sell to anyone, anywhere in the world, and we can leverage the Zoom revolution to do it while this opportunity is still thriving. I made a 100% free guide and free training explaining exactly how this industry works and how you can take your information, your experience, or your expertise and turn it into a six-figure online business. That free guide is available, as I said, entirely for free, and you can download it in the link down below in the description. So what happens next with the housing market, and what do we need to watch out for? Well, the first imperative that we need to see is interest rates falling if this crisis is to end without a bloodbath in the economy. Mortgage rates at 7% is ridiculously high considering how expensive housing is today. Yes, rates at 10 or even 15% was a little bit normal a few decades ago, but 3 decades of rates in the low single digits led to monstrous housing costs that can't be sustained without unlimited free debt. This is exactly why Trump has been hammering Jerome Powell, telling him to slash rates and to do it fast. But Powell is rejecting that call, forever fearful of making another massive mistake and causing inflation to spike as high as it did a couple of years ago. On top of that, those high interest rates are hitting the rest of the economy too, which impacts the housing market further. High rates mean it's more expensive to grow a business, more expensive to buy a car, more expensive to just live for everyone and to generate wealth as an entrepreneur or a business. That means fewer jobs, lower wage growth, and more money spent on debt service as opposed to being reinvested and recycled into the economy to make people richer. Trump's direct methods in dealing with trade wars and tariffs is obviously harming market stability as well. As everyone knows, investors really aren't sure what to expect next, and so they're very cautious with their capital. The equity market has been crazy, 15% declines followed by 15% rises over the course of a few weeks, not the years that we're used to. On the surface, that might not seem like it directly impacts housing, but a huge part of the growth in the equity market was intertwined with the housing market. People were stock rich, they worked for businesses and had options that were suddenly worth millions, and they cashed out to buy homes. People saw their portfolios and their pensions rise, and they decided to splurge on an upgrade to their home. But with that crazy growth now a thing of the past, a booming equity market can't be relied upon to stimulate demand in the housing market anymore. And of course, there's deglobalization to consider, probably the single most important macro event that we're going to see in the 21st century. Trade is now risky and controversial, and politicians are looking inward despite the increased costs of production. That forces prices higher, it stimulates inflation, making interest rate drops even less likely, and it takes money out of people's pockets, meaning less can go into housing costs once again. Banks are fearful too, they have to remain capitalized to a certain extent, and they have to be more cautious than ever when it comes to giving out loans and mortgages, again impacting demand for housing and the market as a whole. Foreign investment is riskier than it's been since the Second World War, which means fewer dollars chasing the real estate in the United States, and again less demand with lower prices. And finally, there's the real ticking time bomb, the same one that actually took down the global economy in 2008. Derivatives, despite what the media would tell you today, are still a huge business that is completely over-leveraged to a ridiculous degree. Mortgage-backed security spreads are at a decade-long highs, meaning the market is skittish and unsure. Those highly leveraged real estate investment trusts, or those hedge funds or other massive players that move the housing market with billions of dollars in debt, well, they're now under huge pressure. As MBS values fall and liquidity dries up, they will face margin calls. Unlike 2008, where the issue was subprime mortgages, this time round it's over-leveraged institutions facing a liquidity crunch that could lead to a fire sale spiral. The derivatives this industry is built on are just as complex and convoluted as they've always been, just as shady and hidden as they were 2 decades ago when they took down the global economy. Commercial property, which is heavily skewed towards these institutional owners, is in crisis, with office space still underutilized, and currently 60% of the loans due to mature this year are facing substantial refinance risk as rates are just so high. The legacy media is begging for a soft landing and some magic to take place to save the housing market from its impending doom, but the reality is there just isn't really a way out of this. This isn't just the market cooling off, and it's not just a market correction, it is a market crash. It's just that housing markets take a long time to crash. In the last case from 2006, it was about 6.5 years for that cycle to take place. So we're only just at the beginning of a very hard time for real estate. No country is safe. The US economy is so all-enveloping that a downturn in their real estate market caused a global financial crisis before, and it would do the same today as well. So if you're like me and you don't want to tie yourself to a sinking ship, check out my Grow Coach free guide and the free training I made to go alongside it. It explains and gives you a step-by-step process to follow to take your information, experience, or expertise and turn that into a 6-figure online coaching or consulting business. A business that isn't locked to any one country or sector, so you can protect yourself against another housing market collapse. There's a link down below in the description box. Check it out and get that download for free.